Hello everyone, welcome back to the channel. This is a very informative and innovative video that we thought we should share with everyone who is taking the February 2022 exam. So as you may know, the same pre-scene is being used over two windows. So the TreadCushy pre-scene for the operational case study exam in November 2021 and February 2022 is going to remain the same. It's the same pre-scene, the same company. So what we thought is, let us go one step forward and help all of the students studying CIMA have access to the entire pre-scene analysis that has been created by us as tutors, as registered tuition providers, so that everybody can learn and take great ideas from the pre-scene and eventually do well on their exam, because the pre-scene is a very important pillar for your study. So I welcome you to this second part of the pre-scene analysis. You would already see part 1 of the pre-scene analysis on our YouTube channel. But now we have part 2, which is the longer, more extensive part of the entire pre-scene available for all of our students. As an extra help, we also have a free operational level mini course, the case study specific mini course for our students, which is available. The mini course includes an explanation of the blueprint areas, free revision material, a free mock exam. It includes a whole lot of details, and the entire mini course is available for free. The link is in the description below. The free mini course can be accessed by clicking the simple link in the description below. It will take you out to our website and you can simply gain access to the whole variety of material. So this pre-scene part 2 is going to cover the financials and every single thing that is part of the CIMA pre-scene which has been released, and you will see that it adds great value to your studies. I welcome you to this video and I'm sure and I hope you're going to find it helpful. Without wasting any time, let us begin. We are now on to part 2 of our pre-scene analysis. So we'll continue from where we left off. A quick recap first. So up until now, we learned the business model of the company, what the company does, what the company's direction is, what the company's core values are, what the company's business direction is. All of that has been covered up until now. If you are unsure about any of the pages that have been done in the pre-scene up until now, I'd request you to first go back, read through it, analyze it, summarize it for your own self, read my explanations again, go through my explanations again, and be sure, and then move on to part 2, because part 2 is taking the pre-scene forward, obviously, but I want you to have a good understanding of the company before you move on to the next part. This pre-scene is something that you'll have to go through many times. It's not just something that you go through once and it sits in your head. That doesn't work. You will be going through this many times. My preference is that you go through it every other day. Read the pre-scene, have it printed out, read it wherever you can, whenever you can, because the more you read it, the more you know about your company, the better you know your company, the better model answers and mocks you will be able to write. Trust me, there is no other way of doing well on this exam other than knowing the company that has been given to us. It is very important that we focus on the pre-scene and give the pre-scene utmost importance. And I'm not asking you to learn anything. I'm just asking you to go through it multiple times. So you've gone through it so many times before the date of your exam, you will automatically know the most important parts. You'll remember it because you will learn it without learning it, because you will have read it many times. So keep reading the pre-scene whenever you get the opportunity. That is very important. Going through it multiple times, very important. Finally, continuing from where we left off, we did the first two directors, We're now on the next director, which is Oleg Scragg. He is the production director. He has been in the post since 2010, having previously been a senior production manager at a garment manufacturing facility. So he worked at a garment manufacturing facility and then moved to us. He has the responsibility for the production facility, which includes the raw material warehouse. He has an interest in sustainable production and works closely with Sophia to continually improve the working practices. So we can say he's worked in the business for about 10 years, so would have developed a deep understanding of the value adding function and how the business works. Also, he's worked at a garment manufacturing facility before, so he might be the one whose knowledge we can use to diversify TreadCushy, because TreadCushy right now only makes athletic shoes. What if we want to make athletic garments? We can use his experience, right? So this is something that we must keep in mind. And also, because Harry wants to expand the business to sell apparels, Oleg's expertise could be a great competitive advantage. So when you're talking about diversification, you can put in the name of Oleg and say that he's the one who has worked at this garment factory before, so he will be able to give us valuable insights. See, by knowing the directors, you can get great value when you write your mock questions with us. Next, Jack Tang. He's the sales and distribution director. So he's been in the post since 2020. He has the responsibility for online sales, the retail stores, and the distribution center. Jack has experience with technology and IT systems and would like the distribution center to embrace the use of more technology. He's the person who's pushing technology. So he's been appointed pretty recently. He embraces technology, which is important for the modern business. Next, we have Emily Queda. She is the finance director. So has been in the post since 2012 and has been qualified as an accountant since 2002. She has the responsibility for the finance department and was instrumental in securing financiers in the early stages of the business. Emily believes that the business is on sound financial footing and it's now time to invest in new products and new markets. So it's a very realistic possibility that in the exam a scenario comes up where the scenario is evolving and revolving around TreadCushy expanding, because everywhere they're giving you that hint. So Emily is well educated. That's a good thing, because you need a good education to run a big company and be a finance director rather. Next, she backs Harry's growth enthusiasm by saying that the financials are strong for further diversification. She will have good connections in the business as she was able to secure financiers. Shows that if we need further investment in the future, can we rely on her? Seems like a reliable choice, because she was able to do it before, and if the business has strong financials, she can do it in the future as well. So she can be someone who powers the growth of this organization. Next, we have Sarah Gomez, who is the HR director. She has been in the post since 2018 when the post was created. Previously, Emily Queda has been responsible for human resources. Sarah has the responsibility for all aspects of human resource management across the business. So Emily first had the role, then they split the role and appointed another director, which is very important, because as the business grows, it's important to diversify the functions and appoint a specialist, because HR is very important, because people make the business. If the wrong people are in the business, if the wrong people are as part of the in their roles, the organization won't do well. So the new HR director appointed in 2018. HR is one of the most important aspects in a company now. So it's important that we recognized it and gave it a specific function, gave it a specific department. That is very important, and our company is doing that. So by knowing the directors and their skills, we can clearly understand the prospect and the standing of the business, which in our case right now seems very good, because all the directors want us to grow. There are good financials, good people running the business. That's our competitive advantage. On to the next page, they now tell us about the different teams that we have, and they're pretty much pointing out towards the structure of our organization. First and foremost, under the production director, there are different heads who report to the director. So, head of purchasing, head of raw material, head of production, head of maintenance, all of these report into the production director who makes the final decisions. That's Oleg Skregg. And this is the clear evidence of a functional structure being in place because there are different functions. Let's say the production function, the sales function, the finance function, all reporting upwards. So, head of purchasing, head of raw material reporting into the production director. Same way for sales and distribution, for online sales, for retail sales, and for finished goods warehouse, they report into Jack Tang. For finance, there is a finance team at the bottom of the tree, I'll say, of which you are one of them. So you are one of the finance officers who report into Ben Newma, who is the finance manager. And then this manager reports into Emily Queda, who is the finance director. Again, a clear evidence of a functional structure is seen over here. As mentioned on the previous page, currently we have a functional group structure or a functional company structure. So, seeing the images above, we can say that the functional structure seems to be in place where similar activities are grouped together, which means all the sales activities grouped under the sales director, all the production activities grouped under the production director, finance activities grouped under the finance director, and there is a degree of specialization generally recommended for smaller sized organizations who are working in a stable environment and do not offer many different kinds of products. It's a very simplistic model to work upon. So I now start to think TreadCushy right now, we can say, is a small to medium sized organization, but it's growing at a very rapid pace. Secondly, this market today is not a stable environment, it's an environment that's continuously changing. Thirdly, TreadCushy offers many different kinds of products. So we can say that we are now starting to outgrow the functional structure. It has its benefits of specialization, better control, more efficiency, but it has its limitations as well, where decisions take long time to pass. There can be conflicts between the departments. So, keeping this in mind, there can be a very realistic exam scenario which says that okay, now TreadCushy is looking to grow and expand. They've outgrown from the functional structure. They're looking at a divisional or a matrix structure as the organization continues to grow. So this is your E1 syllabus. You should know what a matrix structure is. You should know what a divisional structure is and think how can it be applied to TreadCushy as the company keeps growing. So making a quick overview now, we can say that we have Sophia, who has the overall responsibility of the company. She's at the very top. All of these directors report into Sophia, who then makes the decisions. Harry, who deals with product development and IT. Oleg deals with production. Jack deals with sales and distribution. Emily deals with finance. Sarah deals with HR. Making a quick overview. Now, all of these are executive directors taking part in the day to day of the business. They're executive directors, right? No information has been given to us about any non executive directors being existent in the company. In our F1 syllabus, we have studied the topic of corporate governance, which says for a company to be run well, there must be equal number of executives and non-executive directors. But generally, this rule is for a listed company or for a quoted company. So though we are not a quoted or a listed company as of now, following corporate governance guidelines is said to be best practice. So let's say right now we have private equity investors and venture capitalist investors who have invested in our company. In some stage in the future, they're going to want us to be listed so they can liquidate their stake. If we want to be listed, we need to have a good corporate governance structure. So, going forward, a scenario in the exam can also be about appointing non executive directors and corporate governance. So, it's important that we go through this topic from our F1 syllabus. Next heading on the pre scene is other information about the company's operations. So, we're going into more details now. First, the sales markets and sales channels. Now, TreadCushy sells its athletic shoes to customers in Keeland and nine other countries in Europe. So you can see it's not only one country, it's a multinational business. This is something that we have been speaking about from the very beginning in the pre scene. The company has always had a policy of direct selling to customers and does not currently sell through intermediary retailers or wholesalers, which means we have a direct sales line to the customer, selling from our online website or from our app that we have. But this brings me to a very uh, you know question, very straightforward question, which says this seems like a clear opportunity to grow. We're not dealing with retailers or wholesalers like, for example, Amazon or eBay. Why aren't we teaming up with them to sell our products on their website? A lot of companies do it, even elite ones are selling through selected retailers like Amazon or eBay. So this can be something that we look at in the future, because as of now our model is business to consumer, B2C. But is there a B2B opportunity? Yes, there can be an opportunity, because business to business means you will have larger orders, bulk orders, which can help you save and gain extra revenue as well. So, something for us to keep in mind. Next, until 2017, all sales were made online via the company's website. In 2017, TreadCushy opened its first retail stores in the capital city of Keeland. There are now 8 stores in major cities in Keeland and 6 stores in the capital cities of 6 other European countries, which means total 14 stores is what we have right now. And we sell online as well, which we know. So, evidence of being a multinational company, start thinking of risks and opportunities that a multinational company faces. Right now, we are only in European countries. We have not moved to North America, which is a big market, not moved to Asia Pacific, which is a growing market. Something for us to start thinking about. That's why we have done the industry analysis and the first part of the pre scene analysis. That's the ideas that you should start taking from there. Moving on, for the year ended 30th June, TreadCushy's revenue is analyzed as follows. So we have online sales, retail sales. They have shown us the different categories. So from Keeland, majority of our revenue. North Europe, second most revenue. Southern Europe is the third in the list. For retail stores, we do not have any retail stores in Southern Europe as of now. So, something that can be again a growth opportunity for us. If I look at the learnings from this table, if I start to analyze this table, I will see that online sales are 75%, pretty much 75% of my total sales, which means majority of our customers are buying online itself. So our online sales channel can be something that we really focus upon, something that we keep improving, something that we keep, evolving, because that is our major market. So how do we continue to grow our online sales and our retail sales and further expand? This should be a question we start to think about. And we've already dealt with the online opportunities part in the first part of the pre-scene, so hope you've had a good read of the same, because those are ways we can really start to you know improve and grow our sales with the full potential of big data. So as I've mentioned before, make sure that you just keep these numbers in your mind. So when you're writing an answer, You can just say that, like close to 75% of our sales come from our online channel. So that can be something that we look to grow. If you just put that down there, the examiner knows that, this person has analyzed the pre-scene. So these numbers that we give you are something that you can really use and better your answer writing ability. So sales are not uniformly distributed across the year, which means throughout the year it's not the same level of sales. Peak sales are in the period October to December, and then in the period April to June. So mainly in the festive season, October to December, and in the summer season, April to June. And they correspond to new design launches, which typically happen in March and September of each year. Which means once there is a new design launch in March, April to June, lots of sales. New design launch in September, October to December, lots of sales. So when there are new design launches, then we hit peak sales. So what I can see over here is seasonal variations is something that is occurring in our business. So sorry, so seasonal variation, time series, time analysis, when you are selling the most, where you are selling the most, is something that you can focus upon. This is part of your P1 syllabus. So focusing your attention on key business periods is vital for our business. Something to keep in mind, a very realistic exam question can be time series. Next, online sales are managed from an office at the distribution center. Customers can either order from the website or through the TreadCushy shopping app, which was launched in 2020. So, big data opportunities have been spoken about before. We have a shopping app, online website, lots of opportunities. TreadCushy's athletic shoes appeal to a broad range of customers across a wide age range. So, first we have the casual range, which is designed for casual everyday wearing, and it's fast becoming one of the most trendy brands of athletic shoes. Partly because of our appealing designs and partly because of sustainability credentials. So, our core values are appealing designs and sustainability credentials. We must stay true to the same. So, our first range is the casual range. Our second range is the performance range. This is for running shoes and it's growing in popularity. It is currently targeted at people who use running to keep fit or as a hobby rather than elite runners, which means we are not making it for professional sport. We are making it for people who are using it as a hobby or using it as an exercise, not for elite runners. So what if we come up with a product that is focused on professional athletes? That is something that can again be a growth opportunity. For example, if I sponsor or if one of the biggest athletes in the world is wearing my shoes, it can be a whole new level of marketing for me, right? So an upward trajectory can occur if this is seen as a growth opportunity for us. So for both our casual and performance ranges, TreadCushy's prices are slightly above the market average for similar products, which means we are using all these different kinds of sustainable material from different sources. So obviously it's going to be a little bit costly for us. And because it's costly for us to meet this brand image, we have to charge a little bit higher, and that has been evidenced over here. So, key words to focus on that define our strategy. First, premium quality. Because we are focusing on high quality, our prices are going to be high. Second, the prices are above the market average to showcase our sustainability credentials and high quality designs. Third, our nature is innovative. So these are our major strategy holding points. We'll put it that way. And this is straight from your P1 syllabus of different pricing strategies. So something for us to keep in mind. Next, the mix of sales between casual and performance shoes is different in retail stores and online. So they're speaking about the mix which is available in retail stores, mix which is available in online. So this brings out your quantity variances. This brings out your sales variances, sales mix variances. something for us to very well know. Variances is the favorite exam question, and this is from your P1 syllabus. So, something for us to really keep in mind. Next, this is because many customers prefer to come into a store so that they can benefit from the expertise of the sales team when selecting their performance shoe. So, seems like we have a high quality sales team. This is vital for any retail company to do well. Now, my question is, how are we empowering and keeping our employees happy? Is a key concept in this modern world. So, empowering employees, giving them responsibility is very important. So, training and continuous development is what we'll have to look at for our front end staff, which means our sales team, and our back end staff. So, both can work together and look at employee management, look at employee options. And this is part again of your E1 syllabus in your HR section, your employee section, something for us to revise. Many of TreadCushy's customers are loyal to the brand and own more than one pair of shoes. Now, if you like a fitting of a certain brand or a fitting of a certain shoe, you're likely to develop I'll say a biasness for that brand, and brand loyalty, brand management becomes something that is very important for us. Moving on to production facility. Now, TreadCushy makes all its shoes at one single production facility where it weaves the fabric from which shoe uppers are made, molds the soles of the shoes, and where the shoes are assembled and finished. Every single factory activity or production activity, happens at one single factory. So I'm thinking that a single production facility, meaning we are reliant on one production unit to run all the functions. Everything is happening under one roof, and then we are selling in all these different countries, and we are shipping out to our 14 stores and serving our online customers, serving our customers using our app as well. So all the production is happening at one facility. We will here start to think about the benefits and the limitations of having one single unit, which means we have one factory. Let's think of the benefits of one factory. Everything under one roof can be better controlled. The limitations then are, your logistics can become a problem. Management as you grow can become a problem. So as the business grows, can this one site meet the demand? What if we have to expand our production? So if a realistic exam scenario again can be that we are now expanding our production, we are looking at a new factory site. So then topics such as IAS 16, property, plant and equipment, coming to the picture of your F1 syllabus. Let's move on. The site includes a number of different buildings used for different production operations and a raw materials warehouse. Production is typically for inventory rather than to order, which means we have been storing our shoes in inventory. So production keeps going on, we put it into inventory. It's not that an order is placed and then the manufacturing begins. So on completion of production, finished goods are sent to TreadCushy's separate distribution center, which is located 10 kilometers from the production facility. A very clear indication here is that we are not using modern manufacturing techniques such as JIT or TQM, because JIT and TQM produces goods only when customers demand a product. Inventory is something which is avoided in these methods as it's treated as a form of wastage. Over here we have been holding inventory, which means we are not following these methods. So for such an innovative and market leading organization like us, who is dealing with suppliers at a regular basis for these inputs, for these sustainable inputs, it could be a possibility to look at JIT and TQM as we move into the future. This is my P1 syllabus, straight away modern manufacturing techniques of Kaizen, JIT, TQM start to come into the picture here. So something that we need to think about. Now we are speaking about the production process. So this is to tell you what each step in the production of a shoe is, and this will be something that is important for us to know as well, because in the exam they often mention that something went wrong in the weaving of the fabric department, for example, something went wrong in design. So you should not be stumped and not knowing anything about what the production process of the company is. So it's important to know the production process of the company. First and foremost, we design and prototype. So new shoe designs are launched twice a year. We already know that. It was March and September. So whenever you are suggesting something, whenever you are suggesting a new launch, make sure you keep this in mind. Each design starts as a conceptual drawing in the product development department. After the initial approval, the paper design is digitalized using a CAD software, which allows the pattern to be created. So after it's drawn, an actual design is created. From this initial pattern, prototypes of shoes are developed. Different types of shoes are developed and rigorously tested, with the pattern and material requirements tweaked until the perfect shoe has been created. So your pattern is tweaked, material used is tweaked until the best shoe is created. So I'm thinking over here that material requirement planning, MRP, your economic order quantity, EOQ, all of this which is part of your inventory management and your P1 and indirectly F1 syllabus, because when we are talking about inventory management, automatically we'll start talking about working capital. So this whole cycle needs to be kept in mind, and this is again a realistic exam scenario. Material requirement planning, EOQ, inventory management. This also brings into the picture of IAS 2 inventories, part of your F1 syllabus, and working capital management as well. So after the final design approval, any new molding and cutting dies required for production are sourced, and then production can commence. What I'm thinking here is launch events and using other innovative marketing techniques could be key to success for this kind of business. When I'm launching a new shoe, how do I launch it? How do I present it? Something that I need to think of. Step 2 is weaving of the fabric. Now, all the fabric used to create the upper of the shoe, which is the up or the front part or the up part of the shoe of TreadCushy's shoes, is woven at the production facility by modern weaving machinery. We have good machinery in place. The company buys in yarn made from either high quality wool or from wood pulp, and this is woven into rolls of fabric. So, an opportunity to implement JIT and TQM here. We rely on high quality supplies, and establishing good supplier relationships could be key for us. So, something very important mentioned here: modern machinery is being used. So, management of this machinery, depreciation of this machinery, or refurbishment of this machinery is part of IAS 16, and your impairments IAS, both of them are in F1 syllabus. So I have given you so many ideas on this page. Hope you have a piece of paper that you are writing this down on. This is very important stuff. As I'm discussing the pre-scene, you will see that my points have already been put down, but if something new comes to my mind, if something important comes to my mind, I'll always mention it. So you should be ready with a piece of paper or a word file where you are making notes of this, because you will be reading the pre-scene many, many, many times, and I don't want you to miss anything. Step 3 in making our shoe is the cutting process. Now, each shoe upper consists of a number of segments that need to be cut out from the fabric that has been woven. Obviously, cut it according to size, shape it. Two methods are used to cut out these segments: by hand cutting or digital laser cutting. Now, what I'm thinking over here, that for such a innovative company, we are still using hand cutting, and we have the option to use digital cutting as well. So why aren't we completely making it automatic? by using a digital laser cutting machine, because the more labor intensive the process is, the more costly it's going to be. So, are we looking to increase our laser cutting machinery so that we can use this for cutting more shoe uppers? This could be faster and more effective as well, right? But this brings in the need for capital requirements, because you may need to buy new machines. So, how will you source that capital? Brings in your F1 topics. Also, because if you're looking to invest in a new machinery, you can buy the machinery, so IS 16 comes into the picture. What if you're looking to lease that machinery for a long term lease? Leases with IS 16 part of your F1 syllabus again. So see how we're bringing into different scenarios. After the cutting part is the stitching part, step 4. Now all of the segments of a shoe upper are stitched together by one of TreadCushy's skilled craftspeople. So even after the cutting process, which is labor intensive, the stitching process is even more labor intensive, where skilled craft people using modern sewing machines designed specifically for the task shoe these, or I'll say stitch these layers and linings together. So at this stage, eyelets are stitched into the uppers ready for the laces, which means those holes where you put your laces in, that is what is stitched over here by these skilled craftspeople who are using machines. Next, step 5 is molding of the soles. At the same time as shoe uppers are being made, just the up or the top side of the shoe, a separate production team makes the midsoles and the outsoles, which means the bottom part of the shoe, the inside part of the shoe. Pellets of natural rubber and a composite made from sugarcane are combined in a melting vat, and the soles are molded by an injection molding process, which means the rubber is soft obviously when it's melted, and then the shape is given to it, and that shape of your shoe is called the injection molding process. So that is exactly what this process is about. I just put it in my own words for you to understand it. Step number 6 is called the lasting process. Now, the lasting is a process where the shoe is assembled and takes its shape. As you can see, the image down below just showcases to you what the machine looks like that is used over here. So, a last is a metal model for the foot shape relevant to the type and size of the shoe being created. Lasting machinery is set up with relevant lasts, and a floppy shoe uppers are stretched onto these lasts. They're put onto these lasts so it takes its shape. The bottom ends of the uppers are folded over onto the base of the last, and the midsole and the outsole of the shoe are then pressed onto the uppers by the machine, which means they are joined together. So the upper, the midsole, and the outsole are joined together in this stage. After the sole is added, the shoe is taken off the last and is ready for finishing. So this is the lasting machine where the upper and the bottom side of the shoe come together, and finally a shoe, it looks like a shoe. A shoe is ready. Step number 7 is finishing. Finishing involves adding insoles, laces, and labels before the final quality checks, and packing into a distinctive recycled cardboard TreadCushy shoebox. Obviously, we are a sustainable company, so our packaging also has to be sustainable. Next, we move on to the subheading of purchasing and suppliers. So the main raw material inputs to the production process are, first is yarn. We use a lot of yarn. So there are two types of yarn used by TreadCushy, one made from wool and the other made from wood pulp. So there can be often questions about, like I said, material requirement planning, your different variances, material variances, sales variances, labor variances as well, because as you can see, our production process is quite labor intensive. So these can be variance questions that have a huge chance of coming up in the exam. You must have revised these topics. Each type of yarn has a single supplier. Both suppliers create their yarns in Keelan from natural resources, sourced sustainability in the country. Now, single supplier and multiple supplier relationships should be analyzed here. What is the what is the benefits of having a single supplier? What is the benefits having a multiple supplier deal? Start thinking about that. Next raw material we have is natural rubber. Now, natural rubber in pellet form is sourced from three different suppliers here. Two are from Asia and one is from South America. Could be because of cost advantages. All three of TreadCushy's natural rubber suppliers are members of the World Federation Alliance of Sustainable Sourcing. It's our competitive advantage. We are staying true to the brand. Next, our third raw material is sugarcane composite. So, since TreadCushy was founded, it has worked with TB Sweet Nature, a company based in South America, to develop a composite based from waste product of sugarcane. So, together, these two companies were in a strategic alliance or strategic partnership where both helped each other. TB Sweet Nature gave TreadCushy this composite. TreadCushy supported them by giving them bulk orders. So TB Sweet Nature is TreadCushy's only supplier of this composite, which was used in production of shoe sales. Now, working with single suppliers to develop cutting edge products gives major benefits in terms of sourcing and competitive advantage, as you can see in this case. This is something that major companies are doing all around the world, and this is a good opportunity and a good method for us to follow. Now they're telling us that TreadCushy buys from range of suppliers mostly based in Keeland. So we are mostly buying from suppliers who are based in Keeland, which means insoles made from castor beans, laces made from recycled plastic, cotton thread, and packaging material from recycled cardboard. This is all that we require for our production as well as packaging. TreadCushy makes a conservative approach to raw materials inventory management and takes advantage of bulk purchase discounts wherever possible. So, my method of inventory management, raw material management, and I will say related to working capital management is the conservative approach. Payment terms granted by suppliers range from 30 to 60 days. I need to pay in this much time. So your F1 topics of working capital management become very important here. Your last chapters of F1, very important. So now let's make a quick study on what the conservative approach really means. Now, long-term finance is used for most current assets, including a proportion of fluctuating current assets. Stable for the business but expensive, as you may have high level of working capital which is not being utilized, which means you are only at most of the times you don't invest in raw material. Only when you have bulk purchase discounts available, you'll use it and purchase your raw material, which means sometimes it can turn out to be counterproductive because you have money lying there, you are waiting for a discount, you have money lying there. So it's not very possible, or it's not very proactive in today's modern world. A firm choosing to have a lower level of working capital than its rivals is said to be aggressive. Less working capital, less cash ready, more cash invested in other places means you're aggressive. Whereas high level of working capital, money kept aside, not being used, is a conservative approach. That's what TreadCushy is doing right now. So an aggressive approach can lead to high profitability, but it's very risky as well. Conservative approach will be low profitability and low risk. So because I can say that my directors are so well informed, my directors are looking at growth, why not have a I'll say a fusion of a conservative and an aggressive approach, something in the middle? Why not find something which gives the business more profitability? Just a thought process, right? Next subheading we now move to is distribution center and logistics. And the company has a distribution center located 10 kilometers from the production facility. The distribution center includes a large warehouse for storage of finished goods. There is also an office from which all online sales and retail store logistics are managed. The process in respect of online sales is as follows. So, goods are received from the production facility via the company's own delivery vehicles on pallets, which means you have your own delivery vehicles as well. You are a vertically integrated company. But can we, outsource this part? Is it possible? Next, pallets moved via forklifts, forklift trucks to finished goods warehouse. From there, order received from customer and checked to ensure that the customer is paid. The picking of goods by robots in the finished goods warehouse happens. Whatever the customer is ordered, the robot picks out. The picked goods sent to the packaging hub, and goods are checked to order manually, making sure everything is right. We don't want any returns. And goods packed in the packing hub manually. Again, this is something that is happening manually. So this is, I'll say, something that the business must look at, something that the business must invest to remove human interference as much as possible. Use machines, use machine learning, use good quality measures, so that you don't have to keep checking and checking over and over again. Once it's checked, everything is fine. And then the order is finally dispatched to the online customer via third party courier services, which means this part has been outsourced. The last delivery part has been outsourced. It could be a good decision, because setting your own delivery agents is a big logistical issue. So for now, this seems like the good approach, that non value adding activities are outsourced. That's okay. Moving on now, dispatches to our retail stores are carried out by an international logistics company, because we need to send these goods to our retail stores as well, right? So, again, this part has been outsourced, shows that we are willing to let go of non value adding activities. TreadCushy takes a conservative approach to the management of finished goods inventory at the distribution center, which means you'll keep more inventory than you are needed to. More money is invested here than you are needed to, because you are conservative in your approach. This is to ensure the full range of designs, colors, and sizes are available for quick dispatch to customers. So, like I said, there is an opportunity for us to be a little bit more aggressive, to generate a little bit more profit for the business, something that we can think about. Next, we speak about retail stores. Now, there are currently 8 TreadCushy retail stores in Keeland, all located in major cities. There are a further 6 retail stores in the capital cities of other European countries. Each store is fitted out in the same way and displays the full range of our shoe designs. So each store, we are maintaining our standards, maintaining our display, maintaining the consistency. The retail stores sell only the TreadCushy brand, which is very much what we want. So if you look at an example, if you look at Nike's floor plan, you'll see that they have a free flow system. They have active music, customer engagement, high quality sales team. So these are characteristics which my business also should follow. I've just put it here as an example for you. Each store has a store manager who has responsibilities of inventory control, recruiting, and training the retail employees. So we are avoiding responsibilities at the lower level as well, which is good and important for employee empowerment and better control. Each of these store managers that we are speaking about has been given a monthly target that they're expected to achieve. So each store manager is given specific responsibilities. This brings in the concept of responsibility accounting, where once a manager is given the responsibility of an area, he's held accountable for the successes and the failures of that area. So responsibility accounting or responsibility management is important. Each store has touchscreen monitors giving customers information about the benefits of the use of natural resources. Pretty standard. Coming to the next part, which is on employees. Now, as of 30th June 2021, we had 535 employees, which means it's not a small company anymore. It's moving into the medium to the large range. So production facility had 284 people. We've spoken about reducing the manual interference in the production process as much as we can. Distribution center at 124, retail staff is 98, and head office staff is 29, which means in these 29 people, product development team, finance team, and HR team is included. So my question is, only 29 people are here to manage the most important function of the organization, which is the strategy, the day-to-day running, the management of the organization. The breakup of the head office function is not given here. So we are assuming that, IT, HR, finance, accounting, marketing, sales, everything falls under this, right? So IT is ever growing in this digital world. And for our business, we have app management, website management. We may need further investments or further recruitments in this area to support our expansion. Similarly, innovative marketing and sales techniques are being promoted all over the world. If our staff are under unrealistic pressure and they're not able to perform their duties, the company will lose. Most importantly, HR function is not given a lot of importance over here because we have a separate HR director, yes, but that was very recent. But up until then, HR was combined into the finance director's function. People make companies, and having the right competent people is imperative. Also, the finance function, which is ever evolving and demanding, needs to be taken into account. Now, if these 29 people are split in IT, HR, finance, accounting, marketing, sales, you can see that there will be 4 to 5 people in one team. Are they able to manage everything as the business grows? If there is unrealistic pressure again, then the business is not going to prosper. So something for us to look at: employee management, better management of the organization, and this HR part needs to be looked at, which is part of your E1 syllabus. Now coming to a very, very important discussion, which is your costing and budgetary discussions. Very important. So the company operates a standard absorption costing system using departmental overhead absorption rates based on direct labor hours or machine hours for both variable and fixed production overheads. So may it be variable or fixed overheads, we are using direct hours or machine hours to cost our products. Very clearly, this is from your P1 syllabus. We need to know the benefits of each and every costing system, the limitations of each and every costing system. For example, a standard costing system, what's the benefits and advantages? From our syllabus, we must clearly know it. For our marginal costing system, very clearly we must know the benefits and advantages. For activity based costing, very clearly we must know the advantages and how it works, and disadvantages as well. So for a big company like ours, which is progressive in its thinking and produces different kinds of products in different variants, very many different variants is what we have, right? A robust costing system is very important. A standard and traditional absorption costing system has its flaws, and this is where your P1 syllabus comes into play. A change to activity based costing can be a very realistic exam scenario, and that is why you must clearly know costing methods. Standard cost cards are produced for each shoe design and are updated annually. So we are having an annual updation of the cost card. Do you think it's very proactive? Because if you have an annual cost card updation in 1 year, there are going to be so many fluctuations. We aren't taking into account of the same. So all of this is very standard in the standard absorption costing system. That's how it works. And that is why it has its flaws and its advantages as well. This was for costing. For the budgets part, we are using an incremental budget system. So there are various advantages and disadvantages to using this type of system. Again, this is your P1 syllabus. What are the different budget systems that we have? our incremental budgeting, participative style of budgeting, the different budgeting systems, the annual budget system. We'll try to look at all budget systems, flexible budgeting, beyond budgeting. These methods are very important for us to know from the P1 syllabus. Managers have limited involvement in budget setting and limited budget responsibility as well. So we have limited involvement as well. The managers get very little input. This paragraph mentions the use of a top down approach where budgets are set by the top management and then the lower level management simply follows the same. This would not seem to be very beneficial in today's modern and dynamic business environment, right? Because top level is setting, bottom level is following. This is very standard. It's not something that works in today's world. On the other hand, there is a bottom down approach or a participative approach where everybody participates and creates the budget. Both methods have their advantages and disadvantages. We must clearly know and ponder upon the same, think upon the same. This is a very important page that I have just discussed. Please make sure you go into the details of the same before moving on. The next part we are now coming to is kind of an industry analysis that they have given to you. Now, what they have done is they've given you an industry analysis here as part of the pre-scene. But just guess what? You've already done this because we did an industry analysis at the very, very beginning. We've done this at the very start. So we will already know this. It will be kind of a revision for me. So global sales of athletic shoes, global footwear sales in 2020 were $180 billion, of which 70 billion can be attributed to sale of athletic shoes. In the footwear market, 70 billion was athletic shoes, a very big market with new opportunities available every day. We already know that. The market for athletic shoes is dominated by 4 major athletic shoes and clothing brands that have a global presence. In our industry analysis, we also did this, that competition will be a key factor because it's a consolidated industry. There are 4, 5, 6 players that dominate all over the world. For us, our local credentials have made us the preferred choice for Keelan customers, and we have grown this brand to other nations. These 4 brands have operations all across the world and sell a full range of athletic shoes and clothing. This can be an opportunity for us. We are only selling athletic shoes, but our management is keen to expand into clothing. The other brands that sell athletic shoes can be categorized as either non-specialist or specialist, with the brand incorporating athletic shoes and clothing or just athletic shoes. Specialist brands are typically relatively small companies that focus on a niche market, such as athletic shoes from recycled materials. TreadCushy is an example of a specialist athletic shoe only brand. You have advantages because you are a specialist on a small niche market. The $70 billion of global sales of athletic shoes in 2020 were generated as follows. So, 4 major athletic shoe and clothing brands have 67% of the market. Non-specialist athletic shoe and clothing brand, they're doing both, but they're not major brands. There's 14%. Non-specialist athletic shoe only, 12%. Specialist athletic shoe and clothing brands is 4%. Specialist athletic shoes only, which is your market, is 3%. So as of now, we are barely scratching the surface of this market. We operate in 3% of the market share. Growing our share and seeing how we can expand is key for our business. There is so much on the plate. There is lots of opportunities for our business. We need to recognize that. Moving on, of the 70 billion entire entire athletic shoe market generated in 2020, approximately 50% relates to high performance shoes and 50% relates to casual shoes. The global market for athletic shoes has grown at an average of 5% a year over the last 10 years and is now expected to grow by 7%. So, in this industry analysis that they've given, it's showing the same trends that the market is growing. This is due in part to increasing interest in health and fitness, but generally also driven by millennials who see athletic shoes as fashion. We've already done this. You're already one step ahead. Over the last 10 years, consumer shopping habits have changed significantly. In 2010, only 10% of the athletic shoes sales were made online, with 90% made in retail stores. In 2020, online sales is 60% of the total sales. You can see how the market has changed. Whether consumers buy their athletic shoes direct from the brand or from third party retailers has also changed over the 10-year period. So we are only selling directly to customers right now. There can be a business to business opportunity which we can look at. So something that we've already spoken about, but just important for me to point it out for you. Same thing that we spoke has been illustrated as a graph over here. So you will see the percentage of global sales of athletic shoes, online brands, own website growing, sport retailers website growing, general retailers website is a small market but growing, retail stores brand owned very small share but growing, retail stores, if you look at sports retailers coming down, retail stores general retailers coming down at a stronger and a faster pace. What you can see is the trajectory of growth is higher when you have your own stores, or you are selling through your own website, or you are selling through retailer websites as well. So an opportunity for TreadCushy over here. Manufacturing now. The vast majority of athletic shoes are manufactured in Asia for very obvious reasons, as factors of production are very cheap. This is something that has been increasingly happening in today's world. So if TreadCushy wants to expand its production facilities, there can be an opportunity to set up a production facility in Asia. All four of the major brands outsource the productions as a means of keeping cost down, which means these four brands outsource productions. For us, we are not outsourcing anything. Our business model is different, as we focus on bespoke products which are skills craftsmen put together. We have also been charging higher than the average brands charge because of our quality and sustainability credentials. However, over the past 10 years, there have been a number of small companies proving that manufacturing in house can be profitable. And one such example is TreadCushy. So, this was a brief industry analysis provided in the pre scene, but we've covered most of this because we did the industry analysis right at the beginning. Now we essentially move on to the third part of our pre-scene, which is the financial analysis aspect. So the first part was the introduction to the company. The second part was more details about the company. The third part we are now coming to is financial analysis, because we will now analyze, scrutinize, look at the financials of the company that we have been given in detail to understand the financial position of the company, to understand the financial strategy of the company, and just look at every single number provided to us and try to derive meaning from the same. Naturally, the first statement that we'll look at is the statement of profit or loss, which is on your screen right now. So, first, what we'll do is we'll just look at the actual numbers provided in the pre scene, and then I will show you an analysis of the numbers that we have created that will make your job very easy of understanding the company's current position. So, looking at the statement of profit or loss, we have 2 years given to us, 2020 and 2021. A clear increase in revenue can be seen. A clear increase in cost of sales can also be seen. And gross profit has naturally gone up. Our selling and distribution expenses gone up. Admin expenses gone up. Operating profit almost doubled. Look at the operating profit, almost doubled. Finance costs remain the same. Profit before tax went up, obviously, because the operating profit has doubled. Your income tax expense, which means you paid more tax in this year, and then your profit for the year is almost double again. So in 2020 to 2021, you have doubled your profit for the year as well. So let's now make a numerical or a ratio analysis on. So on your screen is a ratio analysis or a percentage analysis that we have created according to the figures that we saw in the statement of profit or loss. First and foremost, you will see that the revenue has increased by close to 14.58%. Cost of expenses went up by, or cost of sales went up by 12.24%. Your gross profit went up by 16.83%. Selling and distribution expenses went up, admin expenses went up, but our operating profit almost doubled, went up by almost 100%. Exact figure is 94%. Finance charges, no increase. Increase in profit before tax is 107.7%. You can see that the numbers are very positive for the company. Now, why have I provided these numbers to you? Why is the financial analysis important? Let's just put that into perspective. Now, why these financials are important? First and foremost, because it helps you understand the company better. Secondly, while writing mocks, you can keep this picture, you can keep these images in your mind, you can keep these numbers in your mind and actually use them to write a better answer. For example, let's say you're talking about growth. You can start your answer by saying that our operating profit has almost doubled and is close to 94%, which means the company has strong financials and we can now push forward into other growth avenues. If you just write something like that, if you're so specific in your writing, just imagine the examiner knows that this person took the trouble of going through the pre-scene, making the ratios. You don't have to show any calculations. We've done that for you. All you have to do is simply replicate them. And I understand that you can't remember all the numbers, all the figures that are on the screen. That is why I have put some in a red highlight or red underline for you, which you can try to remember and then easily use them when you are writing your mocks. I'm not asking you to learn them. Read the pre-scene multiple times. Read it so many times that these numbers are automatically imprinted in your head, and it's possible. Students are doing it. So, firstly, it helps you understand the company better. Secondly, these financials used as part of your mock answers add a whole lot of value. And then, according to these numbers, we've provided you with conclusions as well, which we have already discussed. I've already gone through them, but just pause the video here, go through the conclusion, and you will see that, everything that I just spoke about is put into words. So if you read it multiple times, this will automatically be set in your head. Same way, we have the statement of financial position on your screen now. So the statement of financial position also given for 2 years, 2020 and 2021. We look at some important numbers. First and foremost, you'll see property, plant and equipment has decreased. Maybe there was a sale, maybe some asset was redundant. We don't know, we'll think. Right of use of assets, which means assets were taken on lease and we have recognized the same over here. So your IAS 16 leases becomes ever so important. Moving on, they'll give us current assets. In the current assets category, inventory has gone up slightly. You can see the amount of inventory that we are holding because we have a conservative approach to inventory. Receivables are pretty much remaining the same. Cash and cash equivalents has gone up drastically. We are holding a lot of cash at this moment. So are we looking to invest in something, or is this cash just sitting there lying useless? Need to think about it. On the equity side, retained earnings gone up obviously because your profit has gone up. Borrowings have remained the same. Lease liability went up a little bit. Right of use of asset had also gone up a little bit. May mean we have taken some assets on lease in the current year. For trade and other payables, they have also gone up, but that's also a huge number. So we are using the entire 30 to 60 days that we are given to make the payment. Tax liability has gone up and lease liability has also gone up. Pretty straightforward, but going through these numbers gives us an idea of the thinking behind the company's strategy. So you also go through the numbers your own way, read through them, spend time with them. It can be that you come up with another explanation, or you come up with another perspective, you come up with another idea. That's okay as well. We have no issues. But your own perspective is very important. You'll have to spend time, you'll have to commit that time to understand these numbers. And trust me, every time you read them, you can have a different point of view, you can have a different explanation that comes to your mind, and that's a really good thing. So same way, ratio analysis has been created for you over here, and you'll see it on your screen. First and foremost, we create a very important ratio, which is the return on capital employed. You'll see that the return that the investors are getting, or the shareholders are getting, are close to 42%. It's a very, very good return on investment for any company, any private equity investor, any venture capitalist. It's a very good return. Non-current asset turnover is also good. Your current ratio is the current ratio and the quick ratio indicate the liquidity position of the company. In this case, the liquidity position of the company has improved from the current year. It is interesting to note that majority of the current assets is tied up in our inventory. Inventory forms a very big part. Inventory cannot be sold off as easily as the other current assets, and hence we remove it when we do our quick ratio calculation. Our return on assets have doubled in the current year, which shows profitability has increased, which we very much know. Over here, gearing indicates the ratio of debt in proportion to total capital structure. A very minimal decrease in gearing here indicates that a small proportion of the debt, has gone down over here, decreased slightly, but it's not a very fundamental difference which could be showcased. So it's not too much of a concern. From an examiner's perspective, what I try to do is I try to remember a couple important ratios, couple important numbers, and then replicate them as always. So try to remember ROCE, try to remember return on assets, try to remember quick ratio. Use it when you're writing your answers. It can come out to be really useful and really informative for the examiner who is reading and checking your answers. Coming to a detailed cash flow analysis now. Cash flow is very important for any business. No matter how much profit you have, you cannot run the business based on a profit. You need to run the business based on cash. So evaluation of cash is vital. Cash flow always is split into three categories: operating activities, investing activities, and financing activities. So we will look at three of these categories one by one. If you look at the operating activities, you will see that adjustments were made for depreciation, for profit on sale, depreciation on right of use, and you get your final cash flow from operating activities. So we can clearly see that we sold a part of our property, plant, and equipment at a small profit in the current year, and hence you subtracted it back to the PBT, because cash flow works in that way. We already know it. In 2021, our working capital decreased because there has been a greater increase of current liabilities than current assets. So inventory went up, receivables went up, but trade and other payables went up by a greater margin. Due to decrease in the working capital, there has been a net inflow of cash. So you get 344 as your balancing figure, and your cash generated from operations total comes up to be 8123. Very clear. We move on to the next part, which is cash flow from investing activities. So from investing activities, it is very clear that a purchase of property, plant, and equipment was made because our PPE had gone up, and there was a disposal of property, plant, and equipment of 80 given as part of the statement. So there has been a $13,000 profit on an asset that was worth 67, and new PPE was purchased. How did I calculate it? If you can see, proceeds on disposal were 80, which means when I sold the asset, I got $80,000. Out of that, profit was 13,000. So the value of the asset at the end of the day was 67,000. Just making a small analysis for you. That's the only entry in cash flow for investing. Under the financing activities, you can see that a huge dividend of 2000 and then another three zeros was given. I'm just reading it the way they have provided it to us. So 2 million of profit, or I'll say 2 million was paid out as dividend, and that mainly could be because of the need of our venture capitalist investors, private equity investors. Yeah, there can be a repayment of lease principal, which is showcased over here, 65,000 clearly on your screen. That gave you your net cash outflow from your financing activities. So we also paid dividends to our shareholders in the current year. The dividend payment ratio is almost 50% of our net profits earned. So almost 50% is being paid out, and the other 50% is being invested in the business. So it's important to note that the sustainable growth rate depends on the retention ratio and return on equity. Higher the retention ratio, higher the sustainable growth rate, because more you retain in the business, the more you invest in the business and more the business can grow. So if we want the business to grow in the future, then we may have to reduce the dividend payments a little bit so we can invest further in the business. And that is the analysis of your cash flow statement. Again, you go through the statement by yourself, you go through the explanations that I have made. If you come up with any other aspects, or if you come up with any other point of views, all you need to do simply is just make a note of it and provide that analysis to us so we can make a discussion in our class. But something as complex as the cash flow analysis will require you to go through it multiple times. Don't try to learn, try to go through it multiple times. After our detailed financial analysis, the next aspect that we speak about is budgetary analysis. It's part of the financials itself, but it's more your P1 part. Analyzing budgets, looking at budgets, looking at the direction that the company is headed into, how the company is costing a product. All of that is what we'll be going through over here systematically, one budget at a time. Now, the first budget that we look at, and that is on our screen, is the total budgeted gross profit. So first and foremost, we have two ranges. We already know that, the casual range and the performance range. Now they're telling us that under the casual range, we have the wood range and the wool range. In the performance section, we have the hill range and the flat range. Revenue from each has been given to us over here, and cost of sales of each have been given to us. And then they have also created and calculated the gross profit margin and given to us. We can see that our margins are constantly above 50%, which is a very good thing. We are maintaining our costs well, let's put it that way. To make a detailed analysis now, we expect about 62% of our sales to come from our casual range of our shoes, and about 38% from the performance range, which means majority of the shoes that are being sold is the casual range. That's our more revenue generating line. In the casual range of footwear, we expect about 64% to come from the wool category and 36 from the wood category. So in the casual range itself, 64% is wool, 36% is wood. So by having these numbers, I can know what the customers want. The customers are currently preferring wool casual shoes. In terms of profitability too, the wool category is more than the wood category. As you can see, wool is 54 and wood is 50% gross margin. So currently we are selling more of a product with more profit margin, which is a good thing for my business, right? Next, in the performance range of footwear, 64% comes from the flat segment, while 36% comes from the hill segment. In terms of profitability as well, flat is better than hill. The highest profitability that I'm getting is from the performance flat segment, which is 59%. So again, these are some numbers or some analysis that if you've gone through multiple times will stick in your head, and you will be able to use it when you are writing about budgets, when you're writing about sales, when you're writing about gross profit in our final mocks. Next, we look at the budgeted sales. So we looked at the gross profit budget first. Now we are looking at the sales budget. Under the sales budget, again, it's been divided in the same way. So sales volume in terms of pairs has been given, which means we expect to sell 774,000 pairs of shoes in this year. Very ambitious as we move towards our 1 million pair goal. Average selling price has been given here and revenue is automatically presented. So casual range will contribute to around 73% of total shoes that are sold, while 27% is expected to come from performance range. So again, casual range is going to dominate in this year. The performance range is almost 50% pricier. It's more expensive than the casual range. Maybe that's why the revenues are low right now. In the casual range, 64% will be contributed by the wool segment, and in the performance range, 64% will be coming from the flat segment, which means the wool range casual segment, one of our highest selling products, the performance range flat segment, also one of our higher selling products. So you can see the expected price, you can see the expected revenue, you can see the expected number of shoes that we are willing to sell and are going to sell, and the same analysis has been provided to you over here in terms of a percentage to help you understand it better. If you feel that by just going through it once, just by skimming through it once, everything will register in your mind, that is not going to be possible. You will have to make sure that you go through it multiple times from the PDF document, from the analysis that you're seeing on screen. It has to be gone through every other day. Next budget given to us is the budgeted cost of sales. Now, if you look at the cost of sales budget, they have given us the expected price of each and every item that is expected in this year. So sales volume in number of pairs is remaining the same as always. The average cost has been taken. So raw material cost, direct labor cost, variable production, fixed production overheads, estimated over here. So raw materials is the most expensive component, contributing to over 40% of the total costs alone, followed by direct labor, then your fixed production overheads, and then your variable production overheads, which means when you're looking at producing such a highly sustainable and innovative product, the input is going to be expensive. And that is why our shoes are also expensive. So raw materials are approximately 40% of the total costs. So reducing the raw material costs can be something that we work upon. Next, raw materials used in the performance segment slightly higher, which is understandable because they are priced higher. The most expensive shoe to manufacture is the hill segment in the performance range. It has the highest cost if you look at it. The cost of sales is the greatest in the wool category, in the casual range, as it is directly proportional to the sales. We are selling very high quantities of wool casual shoes, and that is why the cost of sales is also going to be high. In almost all cases, higher the sales, higher the cost of sales will be, because to make those many products, we will have to put in that much unit, we will have to put in that much fixed production, and this is somewhat distorted because of the absorption costing system that we use, because it doesn't really give us a clear picture as to what the variable production overheads are, what the fixed production overheads are. Why are we apportioning them according to machine hours or labor hours? There could be other drivers of this cost, right? So looking at this cost of sales, we can say that it is something that we have been using until now. But as we look at more proactive methods, activity based costing can be a realistic suggestion, because for our need to better understand variable production overheads, better understand fixed production overheads, so better allocation can occur. And that is why activity based costing is a very important aspect of this syllabus that I want everybody to be very clear about. Now on screen we have a sample cost card. This sample cost card gives us the sample of how the costing is done for casual wool size 40 pair shoe. So what is all of the costs that go into it? Clearly you will see the first part is the materials part. We know it makes up 40% or more of the total cost. For direct labor, if you look at it, it's based on per hour basis, so it's apportioned according to the hours. If you look at the variable production, it's apportioned according to the machine hours. For fixed production, it's also apportioned according to the machine hours, and then you get your total production cost. So analysis of the cost card under the material section first. When we look at the material cost individually, we can see that it accounts for approximately 44% of the total costs. The majority of the material cost is made up of other components, followed by yarn, sugarcane, natural rubbers, and so on. In terms of usage, natural rubber is used the most in manufacturing, followed by sugarcane, and then yarn. If you look at direct labor, the rate of labor per hour is fixed and hence going to be constant throughout the process. We've taken per hour rates and then how much time it will take to make each, I'll say, activity. The most time consuming part will account for the highest cost. In this case, it is cutting and stitching, as it requires a lot more time, which we can see clearly. If we would reduce this time spent in this area, the cost to produce would also go down. The only option is if we can make it machine based, if we can you know try and incorporate modern manufacturing in this picture. Analyzing the other parts of the cost card now, we look at the variable production overhead. The variable production overhead is time spent, and it is something that we are basing off machine hours and labor hours in this case. So weaving in this case accounts for the highest proportion of costs, even though very little time is spent on this. Accordingly, cutting and stitching is a lot cheaper, even though it has the highest time allocation. Why? It could be because of the misappropriation caused by using a standard absorption costing system. You don't really know which part is taking how much time, what is driving the cost, the breakdown of the variable costs. We don't really have that. Same way for the fixed production overhead, weaving is the most expensive activity out of all, which is more than half of the second most expensive activity. Weaving, if you look at the standard price rate, you'll see it's 114.80. Same way, the second one is molding, which comes up to 50.60, and then you apportion it based on the time that was taken. So if there was a way to decrease these costs, our overall cost would drop as well. But to understand these costs better, to appropriate and apportion these costs better, a better costing system will definitely be required. And that is why I keep stressing again and again the importance of your P1 syllabus. There are some notes to these standard costing cards and methods that they have given, which is on your screen now. First is that the standards are reviewed and updated annually for any known changes. Updated annually only. Second, normal raw material losses are included. So you're taking into account raw material loss. Again, not the best practice. All direct labor overtime premium is treated as variable production overhead. Idle time is not budgeted for. So your idle time variances, labor variances become very important. Production overheads are allocated and apportioned to cost centers and absorbed on the basis of direct labor hours or machine hours. We already know them. Budgeted selling prices include an allowance for planned discount promotions. So the selling price that you see includes an allowance for discount promotions, which means you've taken into account that, okay, this time I'm going to offer a 10% off, a 20% off. That's already been planned and taken into account. These are just some notes that they have given to you to further make their costing system, their budgeting system clear to you. Now we move to the news analysis section. Now, the news analysis section is something that we have already analyzed for you, and a summarization or a brief of the same is already on your screen. It's already analyzed by us, it's already summarized by us. I just want you to read it. I just want you to go through it so that you can, just remember it in your own words. You can brief through it or brush through it in your own words. It's made very simple for you. It's on your screen now. Pause the video, read through it. It just has some opportunities, it just has some news sections that are at the end of your pre-scene, which have been explained by us over here in your own words. Then there is the tax part, which is on your screen now. You don't need to learn anything. All of this and whatever they want you to know will be given to you in your question as well. So you don't need to pretty much, mug up anything or learn anything of that aspect. It's just generic information presented to you on your screen. For the tax part, you will see that the corporate income tax rate given to you is 30%. Unless stated otherwise, your normal tax rules knowledge from F1 has to be used. Following expenses are not allowable for tax purposes, which means accounting depreciation, amortization, entertaining expenditure, normal from your F1 syllabus straight away. Tax depreciation allowances are available on all items of property, plant, and equipment at a rate of 25% per year on a reducing balance method. A full year's allowance is available in that year that the asset is acquired. Tax depreciation allowances are not available for property assets. It's only available on plant and equipment, not on land. So this is again some generic information. So when you're writing a question in the exam, you can state that, okay, if I am looking to buy an asset, I will get a 25% per year tax depreciation, reducing balance benefit. In the first year, a full year's allowance will be made available. It can be beneficial for my business. So, you can use it in that way. It's not something that you'll have to sit and calculate in the exam, because that's not what the exam is about. Same way, tax losses can be carried forward indefinitely. Sales tax is charged at the rate that they've given. Again, common generic information, nothing too much of a rocket science there. And with that, we have come to the end of the pre-scene analysis. You can see how much detail we have gone into. We want you to go into that much detail when you do the pre-scene every time. Remember, doing the pre-scene multiple times is